Welcome, everybody. This is the 16th episode of the #InvestThis podcast. I am your host, Scott Bauer, and today we have a very special guest. We have Tanner Bickelhaupt with the Tanbic Company. He is the founding principal of the Tanbic Company. He's got over 13 years of real estate finance and management experience. His investment track record includes successfully investing in multiple asset classes in different markets and through different economic cycles. He has been basically involved in the overall strategic direction, including the development investment strategies, sourcing suitable investments for acquisitions, developing relationships with high quality operating partners, and sourcing and maintaining capital and lender relationships through over the years. So, Tanner, I just want to welcome you to the call. Thank you for being here. How you doing?
Yeah, man. Thanks for having me. Happy to be here.
So why don't you go and give our listeners a little bit more about your background and kind of what you're focused on now?
Yeah. So I jumped into the real estate gig as actually just a residential broker when I was 19 years old while going to college and had good success with that. And kind of the long story short is, as the market heated up and I was able to ride it, all the way up until kind of 2009 as a broker. I was able to establish some relationships with guys that, three of them in particular who, I'm not sure, I'm fairly positive, two of them are in probably the top 10 and three of them are in the top 15 as far as size of multifamily owners. And so I approached, one of them and said, hey, I'll work for you for free. Luckily, I'd saved what I'd made. And, but the condition is, please, I need to learn the ropes. I need to be in every meeting. I need to understand your underwriting, your theories and your strategies, and basically just bought my education, which went very well. And so we had some good success. I think we purchased around 9,000 units over a course of, 4 years, mostly in Texas, multifamily kind of value add. And so I was able to get, a 10-year education, and really I was there for 4, but I would say the education, peaked at 2. So from there I spun off into my own, which, like I said, I probably should have done a bit sooner. Started the Tanbic company and with multifamily being kind of the bread and butter. And then ultimately what had spun off on that is, chasing yield. I ended up, being investing fairly heavily and actively investing in the senior housing space.
So that's awesome. Thanks for sharing that. I definitely want to push back a little bit because you were a broker, you said up until 2011 or 2009.
So I'm trying to think when I let my license actually go. So it was 2010 is when I left BlackRock. And so what had happened is that, BlackRock, I was the director of sales up there of we had about a $550 million portfolio. And at that time, predominantly we were working like on second, third home kind of golf course communities. And then we also had the largest urban development going on in the United States at that time, which was 80 acres of waterfront property, which we were getting ready to develop. The issue that happened was 2008. So, those markets, those tertiary markets, they lag. I remember, although at the time, like I was, too green to really understand, but I remember having this thought when there was a Century 21 office up there, and the broker had told me that the Century 21 office in Coeur d'Alene was the number 1 producing office that year. And I remember thinking, like, I don't think that's good. That's a problem, because what drove that market was when Phoenix was hot, Dallas was hot, California was hot, so when those markets were doing well and people had appreciation in their houses and what have you, then they would venture, kind of our way and buy second, third homes. And so I do remember, really thinking like, I don't know if that's a good thing. And it wasn't, because, like history kind of shows us, that market in particular typically lags between, 15 and 18 months behind a Phoenix market, if you will. So whatever is happening in Phoenix, you can pretty much fairly close, see what's going to happen, lagging in that market just, a few months later.
So, okay. So you basically see this happening, start to, question what's going on in the market. And how does that lead you next to, I guess you had made some relationships with some large multifamily owners. You knew that you wanted to be in multifamily. I mean, is that how you made that transition?
Yeah, I mean, what happened is I met some guys that had some success in real estate, but it was always in the back of my mind. And when I say in the back of my mind, I mean, again, that market was so hot. I mean, we were selling hundreds of millions of dollars of real estate there, for each year for a while. And so when it was in the back of my mind, like it was there, but I was, fairly distracted. But I just always, was like, well, how come I'm selling this? And why is this guy buying this? Right? Like, why am I on this side of the desk or this side of the table? Yeah. And so when the market crashed, I'll never forget, these multifamily guys, like I watched guys literally, disappear, financially, and these multifamily guys, there wasn't things, their lifestyles weren't changing. Their family's lifestyle wasn't changing. And I remember thinking like, that's appealing. And then having lunch with one of them one day and saying like, help me, mentor me. What are you doing? And he's like, Tanner, we're getting ready to go buy as much as we can, when everyone else was running and trying to sell assets. And that's really was kind of the first conversation of learning, like, well, what do you mean? Well, Tanner, we invest in cash flow, so our deals are cash flowing, and now things are on sale. And so that's what really kind of started the journey of moving from kind of a residential broker to one in the commercial space, but three, trying to figure out, how you make this all work. So let me get this straight. So you raise money from other people, you use debt, you leverage it, that pays it, and it's tax deferred because I can depreciate the asset. I mean, so it was just like my mind started to like get overwhelmed. And so then I knew, and I felt exposed that I didn't know. I didn't know what I didn't know. And so then I just, like I think everyone should, you go and you pay your dues, right? You make somebody else a lot of money, and you learn, on a company that can absorb it. But most importantly, especially if you're going to raise money or you're going to put money in deals or with friends and family, you're learning with a group that can support that and protect that. Because if a deal goes bad, like if I go to, a pal and I say, hey, you should invest in this company, and that deal does not go well, because I referred them, or if anyone refers them, I mean, you take the blame, right? So it's a whole different level when you start taking people's money. And so I was, fortunate enough to go into someone who has been taking people's money for a long time, growing it and doing it well, and learning the legalities of the package, and how you do that, and then really trying to figure out how to make it better. And so, like I said, I was probably there 2 years too long, because that learning curve stopped in year two. But that was just because I was loyal, and I was in a fortunate situation where I got to see a ton of deals and do a ton of different things. And it's hard to leave when it's good.
Yeah, absolutely hard to leave. And I mean, I have a lot to say there because, on the one hand, I think that that was really, really good for you to stay there. And I think it's good for everybody. I mean, I know myself, I'm very, very eager to make the jump and to switch over into multifamily long term. But at the same time, I'm also taking my time because I want to make sure that I'm doing it the right way. And I don't want to do it. I'm in it for the long run. And I think a lot of other listeners out there that maybe are trying to make a jump as well, you want to be in it for the long run. So you don't want to do something that might compromise that ability to go for the long run, i.e., taking other people's money, putting it into a deal, and then having the deal go sour, right?
Yeah, I mean, I think, what was in the back of my mind is I've been wrong on the multifamily market for a couple of years, thinking like it's too hot, like we're going to peak, with too much supply coming on, all that stuff. Now the fundamentals are still strong, like, and they're showing that they're strong. But, you kind of think like, gosh, it would be a lot better if I entered and started a company in 2011, right? When things were on sale. And if you just got in the game, like literally, if you just bought anything in 2011 that cash flow was multifamily and you figured out how to hold on to it, you looked really, really smart, even if you screwed it up. Like, that's how hot the market's been. Now, you have the smartest equity, the smartest debt, the smartest sellers, you're dealing with, you have to run it perfect. And so it's very difficult to find yield. So with that being said, I hear lots of guys say, oh gosh, it's too late. It's not a good time. Well, it's like family, right? Like there's never a good time to have a baby. You're never financially ready, or your house is never big enough. There has to be some sort of discomfort. I think that's what gives you the edge. But as long as you can, I always preach like philosophy and strategy. Like, don't invest in the pro forma, like invest in the strategy and the philosophy. Like, does it make sense? So we're going to raise rents $100. How? Oh, we're going to put washer dryers in. Great. How does that fit with the rest of the market? Okay, they can absorb it. Can the renters afford it? Yes. Yes. So you keep checking these boxes. Yes, 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 yes. And then you go, okay, well, if I go and I'm going to raise people's rent $100, they're probably going to get upset and they're probably going to move. So what's going to happen to my occupancy? Well, my occupancy is probably going to go down. I cannot tell you how many deals I see of people that are like, hey, I got my first deal. Check it out. And I go through the Proforma and like, I gut them, right? I'm like, you're going to go to your aunts, uncles, your family, and your friends, and they're going to give you money because they love you and they're trying to support you. But what you're assuming, the philosophy of it is kind of correct, but your strategy on how to do it is not, because when you raise the rent, your occupancy is going to go down. So while you bought it and it's 90% occupancy and at the year one it's 95 and you raise rents $100, like that's a fundamental flaw. Like any management company, any strong manager would never underwrite that. But every broker package is going to say that. Every single one, right? You buy it, it only goes up and it's only going to fill up. I don't know why the current guy's not doing it. Like he's leaving millions on the table, right? It's that easy, but it's not. So, yeah, I get off on those little tangents, but that's where people can get stung.
Well, no, I think that's super important, to talk about, is the fact that these brokers are out there to sell the deal. They don't care if you fail necessarily, right? They're not there to protect you. And so you have to do your due diligence, just like any other real estate deal, and make sure that you understand the whole ebbs and flows probably of how that process works. And I think for me, that's one of the things that, I'm not dragging my feet on, but taking my time to make sure that I perfect, or at least get a really good grasp on it before I make that plunge, because, like I said, I'm in it for the long run and I want to make sure that I'm here, and I don't want to jeopardize myself, so to speak.
Yeah. And I think, for guys that are also making the jump, right, especially from like residential, I remember this was like a moment for me, especially in apartments, and I don't know why, in commercial real estate, there's hardly ever a co-broke, right? So especially, if you start to get over like 50 units, you're not going to see, hey, I have a buyer's representation with the broker and this guy has my best interest. So it's really like yourself versus everybody, because the broker, that old adage, like listings win. So they're completely representing the seller, like completely.
Mm-hmm.
And so when you go in, like, you just have to remember that that's where their, where their focus is, and every conversation you have, that's what it's going to lean towards. So, when you're new in the business and you're making the jump, you have to be skeptical. I remember like my first deal with this broker, and he ended up becoming like a dear friend. And I remember I took him out for drinks, and he doesn't drink, right? And I'm like, I am not going to pay this for that. And he's like, well, then you're not going to buy it. I'm like, well, his name's Jack. I'm like, Jack, I'm not going to pay that. And he's just riddled off like all of these value points, right, of why I was going to pay this and why. And then finally, like, I just had to level with him and be like, I need someone on my side here. Like, this is a first deal. I'm going to be a really good client of yours for a long time, but I cannot go out and buy a dud right out of the gates. Like, so you have to help me. Like, let's take out the fluff. Let's, take out the crazy, oh my gosh, let's add washer and dryers, because there's no way I can add washers and dryers in this building, right? It's not feasible versus the cost versus the risk, that type. So let's take out all that hype and just say, what can we do and what can we control, and help me. And then, and what was really good about that is that allowed him to get comfortable with me, to see how I was looking at it and see that I was like dotting my I's and crossing my T's. And then that was conveyed to the seller. And so that's where I was actually able to stick out. So when you do make that jump, it's like putting a resume out there. These sellers, if they don't know who you are, you don't want to you don't want to get the deal just because you paid $2 million more than the next guy, which is really what's happening out there, because I lose those deals to those guys. I put an offer in, I'm underwriting this thing, to the nuts and the bolts, and somebody comes in and they're $10,000 to $15,000 a door higher than me. Like, how's that work? Oh, it's their first deal. Like, that happens all the time. Like, you do not want to be that guy, because you'll do one deal and you'll make fees, and hopefully the market goes up and it takes care of you, but we can't bank on that, right? Like, we got to bank on the things we can control.
So yeah, I mean, there's so many questions that I could ask right now, and I think that I guess it's just important to look at the overall. I don't know, the overall health of what a property could possibly be, the true opportunity, right? Like, what could we really do with that property in order to increase value and value add to that, right? I mean, that's probably in a nutshell what to really look for. Now, you're right. I don't think that taking a look at the market, nobody has a crystal ball, so there is no absolute right time to get in there and buy something necessarily if you want to make the switch, right? I mean, so let me ask you this. I'm wanting to get in. Would you say just get in, do your due diligence, make sure you find a property you feel comfortable with, but pull the trigger if that's the route that you're going to go instead of sitting on the sidelines? Or what would you say to that?
Yeah, I mean, if you can do it and you can put a pro forma together that, one, you can raise money on, and two, is logical and fair, right? Like, you don't need the stars to align. So I still believe that if you're out there and you're hustling, look, if you're trying to buy something that's over 200 units, and it's in a core market, like, you're going to compete institutionally, and like, you literally have no shot. Guys will say they'll have shots, but like, you're going to go buy a Class C asset in the outskirts, and nobody there is qualified as a tenant for the incomes, and I mean, it's going to be a mess, right? Because you have all these groups out there, they're paid to place money, and so that's the competition. So find the niche. So if it's your neighborhood, or if it's a 5-mile radius that like the back of your hand, and you just start getting in, you start making offers, and you start to like get comfortable with the value, right? The odds are the very first deal that you put an offer on and you write an LOI and you do the whole, you're going to fall in love with, and that's bad. You should never have that emotion, but the truth is you're going to, because it's exciting. But when you don't get it, like, that's a good sign. And then you go back to the drawing table, like, why did I not get this? What is sell for? Like, how did they get to that value? And then meanwhile, you start communicating that with your investors, right? Like, the best way to grow investors is not to buy a deal, quite frankly. I mean,
And have reasons why. Like,
right.
This is why we're not doing it. Yeah.
Yeah. So you're out there and you're pitching. I mean, one of the company I was at previous, we found this portfolio deal that I became very emotional about. Again, you're not supposed to, but it happens, especially as you get further along the line. Like, you start to go, because you see the value and you're like, this thing could be amazing. And it can make a ton of money for everybody. Well, as the due diligence went on, like, the thing started to change. It was a $25 million raise. We had $25 million of commitments, like, done. And I had to go back to everybody and say, hey, we're not going to pull the trigger because of this X, Y, and Z, which was the correct way, because it wasn't as good for the investors, and the deal had changed. And it was like, that was probably where my business and personal brand grew the most, right? People were like, wow, that's impressive. Like, you had the 25 million. Yeah, it was all raised. We were ready to go. I mean, the fees on that were well into the 7 figures, right? Like, so that's a hard thing for a company and for people, to turn away. So, but if you're focused on your mission and you're focused on what you're trying to do, which is, again, grow the investor's money, if that's really the first thing you think about and the last thing you think about when you go to bed, when you're doing this, then you should be in the game. So, yeah, just hustle.
Man, that's awesome. So I want to kind of transition over. I mean, you mentioned senior housing a little bit. How does that differ from multifamily, and why did you choose to go there?
Yeah. So, multifamily, like, you're seeing deals, specifically like in Phoenix now. You're seeing Class A stuff, like, it's trading in the 4 caps, like, all day. And so to go buy something in the 4 caps, do all the work, run it perfect, and turn it into a 6 cap. That is a win for an institution in Middle America's pension money, right? Like, so those are the groups you're competing with. They're if they can make 3 to 4% cash on cash, like that's a win because they're beating the banks. And if the market goes up and they can sell it and they hit like a 12% IRR, well, that's even more of a win. So because their parameters are so low and they have zero personal risk, it's tough. So I got frustrated with that about 3 years ago. And so if you start to look at the senior demographics, and if you just Google it, right, like it's coming. But most specifically, like what I'm focused on are the people turning 75 years and older. And even more, what I'm focused on is really the assisted living and the memory care side, not specifically the independent side. So the independent's like your country club stuff, right? Like it's more like a multifamily deal with a lot of amenities, and older demographic. The assisted living, the people that move in there, they need to move in there. They don't necessarily want to move in there, right? So we're providing high levels of care, and then your memory care, which is like your dementia and your Alzheimer's. And so I was victimist as far as, I'm a multifamily guy, got frustrated with the yield going, well, and if you start to read senior housing reports and Proformas, they jump off the page. They are the highest producing cash on cash commercial real estate and have been. And even through the last downturn, it was the only commercial real estate that actually had increasing rents and increasing yield. So when you read this stuff, it's very, very compelling. So naively, I started to go, well, that's what I'm going to do, right? How hard can it be? Well, I discovered very quickly that it's all about the operator. And because now what you're doing is you're providing levels of care and it's serious business, and it's a totally different thing than multifamily. And so it took me a year and a half to really start to find operators because quite frankly, in the space, it's predominantly, over 55% of that market is run by, 5 companies, big, large institutional type companies, and the rest is owned by mom and pops. And the successful mom and pops, they're rich. They don't need your money. They don't want your money, right? Because they have their own culture, and so it's very difficult. So I literally had pound on doors, and I asked brokers who's the best, who runs the facilities the best. And there's this, there's a couple groups that came up, but one in particular kept coming up, and the broker was like, hey, they're not going to want anything to do with you. They don't need you. Well, that's exactly why I wanted them, right? And so it took a long time for us to get comfortable with each other. And so now that I have them, and we have this bar set and this, this marriage, if you will, and now it's really allowing me to start to go get aggressive in the space because I feel like I have the engine now. And so there's lots of people that you can invest in senior living, such as REITs. There's lots of people doing the house conversions, which has a different licensing structure, altogether. Which that perhaps, that may change as the future goes on. Who knows? Because we are dealing with people's lives and their health. And so, we're required over 50 units to have a whole different set of licensing, at least in certain states, than you would if you had a 5-bedroom house or whatever. And so there's a big education piece there, but it's cool because it's also a socially responsible way to invest, because we really are helping people and families. And it's profitable too when you do it well.
Yeah. I have some minimal experience, but some experience on the 10 beds and under in the residential housing. And it's not memory care for the most part that I have experience with, but I think this is a demographic of people. I know, but these people are becoming more predominant, right? People over the age of 65 every single day, that number is just growing. And so this is something to really be serious about and to be ahead of the curve. The curve is already here, but I think we have some time where, if you're thinking about getting into it, it's not a bad idea.
Yeah, I think, I know one of the big issues is Medicare, right? And people, and just caring for our seniors, because it's expensive. It's just, I think families are shocked, when they find out how much it is. And then, if you go private pay, right, which is where the level of care you want, it's far more expensive. And if you go, subsidize, it's tough, because then, the company has to figure out a way to make make a profit. And the way they usually do that is by staffing, right? So some of these places you'll see they'll have one caregiver for every 20 residents, and that's a tough ratio. So
Yeah.
yeah,
People happy.
it's still kind of the wild west on trying to figure it out. Technology lacks. Most of the deals are all sold off market because people don't want to lose their staff or their residents, and so that's where the opportunity is. We're still early in that space, although I say that, and there's 90. I think the last report is there's over 90 senior living facilities in construction or in plan or being prepared to be constructed in the Phoenix Metroplex. So it's coming. Now the big issue is, how are you going to staff those, which is a whole nother story of why I think you need a strong operator who has created culture and can employ people and the people that are giving the care, because that's where all your value is going to come from.
Yeah, that's huge. It's exciting. It's an exciting part of real estate that I think is up and coming, and so I'm excited to hear more about watch your business grow, I guess, and see where it goes, because I'm confident that you'll figure it out and figure out the right way to go. So
yeah, I mean, if you ever if I just was telling somebody today, like, hey, they're thinking that they want to get in actually the multifamily space, and I don't know if we should, and all this doubt, right? And I'm like, what you should do is you should go to one of my senior places and you should go volunteer for a half hour or an hour, just like go and just chat with these folks. And like, you're going to leave there extremely motivated, because when you get some of these old timers and they're reflecting on their life and they're so proud of their families and their accomplishments and whatever, there's almost always a bit of regret, right? Like, man, I should have done this. I should have tried this. I mean, I think I've met, one individual that was like, Tanner, like I did everything. I did all of it. Everything that I wanted to do, I took a swing at it, and it was amazing. And I'm leaving no chips on the table. That's a rarity. So when you go there and you hear these guys, you're going to leave there and go, I'm going, like I'm swinging, I'm going now. Like, what do I have to lose? Right. So, very strong stuff.
that is massive, and I think that is a perfect segue into kind of our to end off the call, the lightning round. So you ready for that?
Yeah, let's go.
All right. Well, what is your hashtag invest this tip to keep our listeners moving forward? I think you just hit it on the nose, but let me know. What is that?
Yeah, so that's a good tip. And then humility. I think every successful person that I know or have been around, like, they have a great deal of humility, and I would argue that has made them very successful. So go to the senior house, have some humility, and you're good to go.
Sounds good. How about are you a big reader? Do you have a favorite book that you've read? What's the impact of that been?
Yeah, I'm reading all the time. It's that's really, for me, it's audiobooks because I travel a lot, right? That's just an easier deal. I'm reading a book right now that's just been, every once in a while, because if you read a lot of these business books, like, they kind of sometimes all say the same things in a different way.
Yep.
And so I'm reading a book right now called Principles by Ray Dalio.
Yep.
And I pick up a lot of little things. And what I like too is there's a lot of books and there's a lot of guys out there that are like trying to teach guys how to do it. There's guys that are just either doing it or have done it. And there's a huge difference. And so when I find a guy like Ray Dalio, who's just literally was the best and had, ups and downs and failures, but, has a strong family and lots of great relationships, like there's just a ton of amazing things, in that book. What else did I read? Relentless is a great book if you're a sports guy. Another one that has Never Split the Difference, which is kind of fun, that's by Chris Voss, and he's an FBI negotiator. So
Yep.
You can get some cool tips in there. And I don't know, man, I read them all.
Well, yeah, I mean, I'm reading Principles right now as well. Never read Relentless, Never Split the Difference. Chris Voss was actually on another podcast, on Joe Fairless's podcast, and I shortly after, I was at a negotiation seminar deal in Florida, and another individual that actually worked with Chris Voss came and spoke at that event. And so that's what got me to read Never Split the Difference. It's a great book. It's all about negotiation. It's a ex FBI hostage negotiator, right?
Yep.
So very, very cool. But great books. Thanks for that. What about advice? What is the best advice you've ever been given? Who gave you that?
My wife would tell you her daily. I, you know, there's I have these moments, I guess, right? So I'm from a very small town and I'm surrounded by really hard workers, like growing up, like people, farmers, they grind, like just physically and mentally grind. And so I think that's been a competitive edge maybe that I've had, is that um, I've just grown up around people that really know how to work and and do it hard. And then as I kind of got out of the farming community and started to, become more interested in business, I would just ask people, but mostly I would just listen. And there was a guy named Bill Morrow, who is a developer way ahead of his time. And he got in all sorts of different business ventures. And when I was like 24 years old and you're kind of like in your 20s and you're trying to just like figure it out, right? Like, how do I make money? How do I do this? And especially with like social media and you see people like doing things very quickly, you're not sure if it's real or not, but like that time scale gets scooted. And he just told me, Tanner, when you get to your 30s, you have to start to make the transition that whatever you do, you have some sort of ownership in. And that always like kind of stuck to me, because I guess I always thought that I was going to be like an employee, right? Like, I'm a loyal guy. I'm going to work hard. And then as I started to progress and get a little bit older, and you started to create, and you start to create value for folks, and you start to make other people money and the whole deal, it just always stuck. Like, I don't have a seat at this table, right? Like, I'm not making those decisions. And so I think my advice is in whatever your professional career is, whether it's investing or, working, whatever, that you somehow find something that you can somehow get some sort of ownership in.
I mean, that's huge. You could take that a ton of different ways, but I appreciate that. That's something that just take ownership, even if it's for your actions and your choices and decisions on which way you decide to go, whether that's working for somebody else or deciding to go start your own business. Because owning your own business is not necessarily for everybody, right?
For sure.
But there's certainly ways that you can take ownership in adding value to somebody else's operation. And so I think that's huge.
Yep, absolutely.
How do you like to give back?
Oh man. I talk to myself a lot about that. I talk to myself a lot in generally. Like, if you ever see me on the street and you're like, does he have headphones in? Is he talking to somebody? No, it's just a Tuesday for him.
So is this guy crazy?
Yeah. I mean, so again, I've been blessed. I have some friends and some investors that's their life focus, right? On like a very big, platform that, everybody listening would, everybody would know who they were. And so I watched kind of their life's work and whatever, and their whole focus, be on, giving back. And, so, yeah, I mean, financially, and when you're building a business, like, I think it's important, right? But also keep in mind, like, you're going to be a good horse someday. You just got to ride you for a little bit. So at the beginning, like, you have to obviously like reinvest in your business and the whole thing. But, and as you become more and more busy, the biggest commodity that you have to give is really your time. And so I think it changes, right? So in my late 20s, it was easier just to give financially. And now, even though I can financially afford it more, most of where I find my value, the thing I have the least amount of, is time. And so, just, friends, family, whatever, things like this, I have a ton of friends, that are investors and whatever. And so, like, looking at deals and just trying to help people, succeed investing, but, by doing it correctly. So I it's all of it. We volunteer for, I have a son that's on the spectrum. And so, autism's a really big passion of ours. And, so we we spend, most of kind of the free time giving back, maybe towards that platform, but it's all of it, man. Just trying to like grow the community and be a contributor with whatever resources I have.
Yeah. Well, and I think, I mean, you said that, you said it already. I mean, you like to give back by helping people, by giving up your time. I mean, you've helped me, you've looked at deals. I mean, we'll go to coffee or whatever, and that takes time out of your day. And that's every time we always have a meeting, or I'm sure other people that have meetings with you, they learn something from you, or, I mean, you're giving your time. And that's the one commodity that we all have a limited amount of, and nobody knows when the clock runs out. Right.
Right.
So, that's huge. And I can certainly appreciate that. Now, how can the listeners reach you if they want to learn more about, either what you're doing or how to get into it or how to maybe make the transition? I don't know if they want to reach you or if they want to learn more about you, where can they find you?
Yeah. So the best spots is probably the website, at tanbic.com, tanbic.com. And then, there's a contact form on there, and then, our folks will get that, and we'll get in touch, and, we get back to everybody, and, so that's the best way.
Sounds good. Well, we'll make sure to put that in the show notes. And other than that, man, I really appreciate you being here today, sharing all the information, just kind of, the transition from single family residential broker and then the downturn and getting into multifamily, kind of the knowledge about making sure that you dot your I's, cross all your T's, and don't be taking other people's money necessarily unless you know what you're doing, unless you want to have, a bad day ahead of you. So, I think it's really important that, you did say in, the best advice side of it is that you got to grind. And that's huge, because nothing's easy and nothing comes to people that don't work for it. So you got to grind. And I think that's a huge piece, and have ownership in what you're doing, have ownership in what you're doing, whether that's just the choices that you're making or the if you want to go start a business or whatever it is, make that a big deal. Right.
Mm-hmm. Yeah. It really is the most fulfilling, whether it's investing or whatever, right, is when you find your groove and you don't know what day it is. There was when I was getting ready to kind of make the transition, somebody posted something, and it was like, one of those, they forwarded somebody's deals, right, and said, if you're living for Friday, like, you're doing something wrong. And I was that guy, right? Because I knew exactly. I knew, Monday was depressing, Tuesday was depressing, Wednesday you started to have hope, Thursday, like afternoon at 4, you were like the most pleasant guy at the office, and Fridays, like, you have 4 cups of coffee, you can't wait to get out, and then Saturday's great, then Sunday, about 4:00, you start to get depressed again. Like, that's tough, and I get it. So, yeah, but once you get in the right path, like, you'll feel it with everything.
That's huge. So if you want to reach out and find out more about him, go to tanbic.com. Other than that, thanks a lot for being here again, and we'll talk to you real soon.
All right, my man. Be well.
Appreciate it.